Well, thank you very much. I'm very happy. I'm very honored to be here. Thank you for the invitation. What I would like to do in the next 15 minutes or so, I'd like to give a little bit of more the academic or analytical background to SME finance. And as you can see, I'm going to touch on many themes that the previous speakers have already alluded to. And I'd like to start out with just kind of providing a little bit the analytical background, why we care about SMEs, why we care about SME finance. I'm also going to give a reason actually why, a no reason why we should care about them, but I will come to this later. So this is, I think we've seen this before. SMEs are the backbone of the private sector in most developing countries. It's a large amount in terms of the number of enterprises, but also in terms of the employees. People employed by these SMEs. And if you go from the numbers to access to finance, you can see a huge, what I'd like to call a size gap in corporate finance. If you look across small, mid-sized, large enterprises here defined by the number of employees, there's not as much difference in terms of access to deposit and payment services, but there is a huge gap in terms of access to funding, external funding, lending by banks, where a large enterprise, for example, in Africa is twice as likely to have a loan or credit line from a bank than a small enterprise. And it's not just the use, so what we observe, but it's also, it seems to be an obstacle for firms. If you ask firms, this is from enterprise surveys done by the World Bank Group, what constrains your operation, your growth, access to finance often comes out top in terms of the growth constraints. And then not just that firms complain, actually if you do dig a little bit deeper and see, does it actually constrain their growth? Yes, it does. So firms that face higher obstacles in terms of access to finance also grow more slowly, and this effect is stronger for small than for mid-sized than for large enterprises. Important here, it's not just finance. Finance is part of a larger business environment that also, for example, we've heard earlier from the chairman of the DAC, the legal system is important, corruption is important, and so on. But finance is a very important growth constraint especially for small enterprises. And ultimately, if you go from the individual enterprise level to the aggregate picture, that can explain why we have the missing middle in many developing countries. This is a relatively old study. I think this is data from the 80s and 90s, which compares the growth difference between Ivorian firms from Cote d'Ivoire and German firms, where Germany is often seen as one of the kind of the model countries in terms of SME finance. Cote d'Ivoire has a very underdeveloped financial system. As you can see, large firms actually grow faster than large firms in Cote d'Ivoire grow faster than large firms in Germany, relatively seen. Smaller firms grow much more slowly in Cote d'Ivoire than in Germany. And ultimately, this divergence leads to what we can call the missing middle. Now, one important point I want to make, and if there's one point you should I hope you to take away from this presentation, is that SME is a very heterogeneous group of enterprises, and we really have to kind of unbundle this universe of SMEs, which again, in some countries, it's basically the private sector, the SMEs. And we have to distinguish between, on the one extreme, micro-enterprises, micro-entrepreneurs, self-financed or self-financed plus, self-employed plus maybe spouse, maybe brother-in-law, household-based, opportunity-based, or maybe lack of opportunity of being employed, therefore self-employed, on the one hand, and on the other hand, more mid-sized and aspirational companies that actually do want to grow and want to become bigger. Now, obviously, it's not just an academic distinction here, but it's also an important distinction because these different firms have different needs for financing. On the one hand, maybe more the microfinance, on the other hand, maybe bank lending, or even beyond bank lending, a point that I want to come back. And of course, this is also critical if we think about job creation. Micro-entrepreneurs sustain the entrepreneur and maybe their family, but have much less impact in terms of job creation than small, mid-sized firms that have growth aspirations. Now, one important point I would also want to make is that it's not the size of the SME segment by itself that matters. It's not having more SMEs makes a country grow faster. Or put it very bluntly, if you split up Philips in many small companies, the Netherlands is not going to grow faster. If you split up Mercedes-Benz or Daimler-Benz in many small companies, Germany is not going to grow faster. It's the dynamic nature of SMEs that makes a country grow faster. And that's where the interaction between the financial system, an effective and developed financial system, and the SMEs come in. Just to give you an example from developed countries, what you have here is the growth rate of small enterprises, of enterprises, private sector enterprises in Italy and in the UK, sorted by age cohort. So starting from the foundation, from the establishment over the following 15 years. And as you can see, British firms actually start out much smaller but grow quicker, whereas in Italy, they start out larger, but they don't grow on average. Of course, there are exceptions. So it's this dynamic nature of the SME segment that matters, and ultimately that's where the financial system comes in, because the financial system helps, or financial development helps small firm more than large firms. It helps create new enterprises. It makes the establishment of enterprises easier. It helps innovation, and it helps also firms exploit growth opportunities more by being able to attract funding for new projects. It also makes enterprises more likely to operate in the formal than the informal sector. Why? Because it's more beneficial if you are in the formal sector, if you also have the benefit of getting access to finance. And ultimately, that's also the channel where an effective and developed financial system can contribute to job creation, which we do care a lot about. Now, actually coming back to a point that Professor Mavrangi just made is, having kind of established now why we care about SME finance, the next question would be, why is it that SMEs are often excluded? And one point is the scale argument that Professor Mavrangi just made. Another one is the risk element. SMEs are typically much riskier than large enterprises. SMEs are much harder to cater to because they are relatively small loans compared to large corporate loans. What we've observed in many countries, also in developing countries, is that even as financial systems deepen, the additional financial deepening, the additional credit doesn't necessarily go to SMEs, they go to households. So the SMEs are often squeezed in between the corporates and the household sector, but the corporates have the benefit of being less risky and being larger, so having the scale benefit. Households have the benefit of large numbers and very kind of homogeneous loan products. SMEs are typically heterogeneous and are much riskier, therefore harder to manage. Now, putting this picture together, this is again the same publication that I mentioned earlier, that the first, my very first graph. You can kind of make estimates of how big this credit gap is in terms of lacking SME funding across the world. Typically, the lighter the color here, the higher this gap. Now, the question is, given all of these constraints, who actually finances small and medium-sized enterprises in developing countries? And typically, it's not just that SMEs are less likely to get access to finance, have a lower quantity of financing than large enterprises, but they also have fewer options available. It's typically that they are limited to bank finance beyond owner finance, informal finance, or trade finance. What often has been kind of the focus of bank finance when it comes to SMEs is what is called relationship-based lending. So built on soft information, repeated interaction between the bank, the company, or even more the loan officer and the owner or manager of the company, enables basically the bank to collect the necessary information, which might not be available from balance sheets, might not be available from having assets that can be used as collateral, and this is basically the way to be able to lend to these small and medium enterprises. However, this is also very costly. Now, linked to this relationship-based lending has often been seen as to be an advantage of small local banks because they have the necessary grassroots in the community. Now, more recently, people have pointed out that it's actually not necessarily only relationship-based lending, but you can actually also use what is called more one-off or transaction-based lending techniques to reach out to small and mid-sized enterprises, where then you could actually get a benefit of scale by having many transactions with many small and mid-sized enterprises, and maybe here larger banks or even foreign banks might have a benefit. Now, if you look at this question across countries, we can actually see that both techniques are being used. Again, domestic, smaller banks use more relationship-based lending. Larger banks or foreign-owned banks are more likely to use transaction-based lending. This is just an example here from Bolivia, where we looked at a sample of firms that have actually loan contracts with both a domestic and a foreign bank. And you can see differences here in how these banks actually structure their loan contracts with these firms, where domestic banks give longer maturity loans. They're also less likely to ask for collateral. However, they do charge a higher interest rate. So there's a trade-off from the viewpoint of the firms in terms of accessing these different financing sources. Now, looking beyond banks, this has been a recent focus more and saying, well, we want to broaden the variety of financing sources for small and mid-sized enterprises. Again, the differences across different subsegments of the SMEs is very important here to consider. When we talk, for example, about capital markets, equity markets, then of course this might be only an option for the top segment of the SMEs, so for the M among the SMEs. Whereas other options more away from public markets, more to private markets, private equity, venture capital, angel financing, maybe it's more for the, could be also for the small business, for small business and not just for the M. Of course, what we've recently seen, especially here in Europe or in the UK, for example, in the US, are these kind of new IT-based forms such as peer-to-peer lending or crowdfunding, which has grown very rapidly in many developed countries. I guess the jury is still out to see whether this is sustainable and whether this can be also rolled out to other countries. Now, very briefly, looking beyond these kind of lending techniques to what is the role of government, what is the role of policy in SME finance. The chairman of the DAC has already pointed to the legal system, and that's certainly a very important part, creditor rights, but also collateral regimes, collateral registries, for example, so to kind of widen the range of assets that can be used as collateral. Information to reduce the risk of lenders when reaching out to small enterprises, such as to credit registry. There's a lot of evidence, for example, from Central Eastern Europe that has been very helpful. Now, one important point here, and I also want to make, is on competition and market structure. I mean, you've heard just the example of Equity Bank, for example, which grew from a very small player to a very large player and has really helped not just itself, and there is evidence for that, in terms of reducing financing constraints in Kenya, but of course also has made the overall banking system, the overall financial system in Kenya much more competitive. Because obviously the other banks also have to react if suddenly one of their players grows very, very quickly. The other, and I can't go through all of them, the other policies, government actions that can be taken to kind of help increase the outreach of the financial system. Agency banking, as it's called in Asia or in Africa, or correspondent banking in Latin America, so kind of reduce the geographic distance between the customer and the bank, create financial identities, especially in countries where passports or IDs do not exist, such for example in Uganda. Mobile banking, again, Kenya is one of the examples of that, where this has worked quite well. So the use of mobile phones for banking services, even beyond payment services. So there are many kind of different examples across the world from developing countries that have shown that can reduce financing constraints, be it in household finance, be it in SME finance. Again, the role of government here is, on the one hand, to have an open financial system that allows innovation, such as, for example, in Kenya, allowing non-bank players such as Safaricom to enter the financial system and offer payment services, but also maybe go beyond that and something we call pro-market activism, kind of provide incentives or maybe time-limited support to bring in innovation into the financial systems. Beyond that, credit guarantees can work under certain circumstances. I have one nice graph here where it shows that in some countries, they have helped to expand the maturity of lending in these countries, which is, of course, another constraint we won't have time to talk about today, but long-term finance, of course, is another very important constraint. So let me just, I have 2 more slides. I know I'm kind of running out of time, but let me just make 2 more points here. One is, in this whole debate on SME finance, I think researchers, academics do have an important role to play in terms of assessing specific policies that have been introduced in specific countries, the effectiveness of the policies, maybe to see what is the binding constraints actually of in the respective countries, but also look at very specific products or specific innovations that have been introduced and see how effective they have been and whether it makes sense to actually expand them into other countries. Microfinance, small business finance, very different animals, which often seen very kind of on a separate perspectives. Although, for example, some players, Beck comes to mind, have actually gone into both areas, started in microfinance, have then moved in a separate institution to SME finance, for example. What can one learn from the other? I think it's a very important debate. And, of course, demand side constraint, Professor Mwangi has already alluded to this, financial literacy, not just an issue on the individual level, but also on the business level. So let me conclude. SMEs are the private sector of the developing countries. We want them to grow. We want them to be dynamic, not just the SME sector by itself, but having a dynamic SME sector. And here is where the role of the financial sector comes in. We have to distinguish between these different segments within the SMEs that have very different needs, which also implies different players in the financial system reach out to different segments of the SME universe. And we also have different policy levels that can be used, again, for these different segments. Long-term institution building, but also shorter-term competition enhancing, or even what I call this pro-market activism to kind of help jumpstart the SME segment. Thank you very much.